Good morning, everyone, and Happy New Year. Welcome to Tax Notes Live. Thanks for joining us. And just to warn you, this could be my last Tax Notes Live broadcast ever, because if I hit that lottery tomorrow night, Powerball, $700 million, you won't have David Brunori to listen to anymore. I'm just going to be honest with you, as much as I love you guys. But for now, for the next hour, we're going to be discussing recent state tax developments. We're going to move on to our first story, which is not surprisingly the Gillette case. There are a few bigger developments than the so-called Gillette litigation in the state tax world. The California Supreme Court overturns one of the most significant developments in state tax practice and policy in the last decade. As you heard, the court unanimously decided that the multi-state tax compact is state law and not a binding reciprocal agreement amongst its members. When the Gillette case was decided in the lower courts in 2012, it rocked the state tax world, as many of you know. I find Gillette and similar cases around the country to be fascinating. As many know, I am no fan of the state corporate income tax. I believe it should be repealed. But if you're going to have a state corporate income tax, you need a few things, and uniformity is one of them. The idea behind the multi-state tax compact, at least how I always understood it, was to create a uniform way of taxing corporate income so there would be no double taxation and no nowhere income. Business disliking the former and the states ever worried about the latter. The problem is that over the years, as you all know, the states have steadily moved away from even pretending that the corporate income tax was important. Various states watered down the apportionment formulas, half refused to adopt combined reporting, and of course, virtually all states dole out tax breaks in the name of economic development. And if the corporate tax is not viewed as important, then uniformity certainly is not.